Ladies and gentlemen of the crypto space, we're live on a Friday, January 27th. Holy crap, it's the end of the month at 11:32 a.m. So, there's many thoughts that come to mind today to start things off. Obviously, thinking about liquidity as basically the core of what drives markets. Obviously, I've been hitting home on that topic more and more on social media, but with so much going on in recent history of the stories I've been telling, I really want today to start off with people's thoughts, people's questions. Ultimately, I understand the markets. I understand what drives markets. I understand relatively the directionality of markets, and I would just want to help other people understand them to the best of their abilities. There's too much talk of this stupid Fed funds rate. There's too much talk of what was the other component that people, oh, this whole recession talk, and it drives me nuts because people look to those particular things like they're so meaningful in what's going to happen in the markets. And there's just so much opportunity everywhere. You just have to see the common thread between everything, and ultimately that's liquidity. Is liquidity going up or is liquidity going down? And where's that liquidity going? Dollars, currency units. Because if you want something to go up, you look at the cash in the market because the cash is going to buy something. If there's not volatility, if there's not risk, and that for that we look to the bond market. Let me see if I can help. Let's start with some questions. We'll pop it over to the main screen. Obviously, we'll look over currency charts. We'll look over our favorite crypto assets, and I'll talk, but let's start with you guys today. Joe, my question will be about the debt ceiling and its potential to extend the bear market. The debt ceiling is not extending, it's cutting the bear market. The debt ceiling is forcing the TGA to draw down its account, and we see that visually on this chart. We note that liquidity is up. Liquidity was down, and this, whatever the metric is, 144.22, but liquidity is up to 156.37 over the last, was that week? Yeah, over the last week, give or take. So liquidity has ramped up significantly. It has not really violated any of these trend lines. The significance of the trend lines, the moving averages, I don't entirely know, but it looks like everything is flush with liquidity. Everyone's talking about QT draining liquidity. There's a tremendous amount of liquidity in the system. Even if this stayed the same, the amount of currency units added to circulation is extraordinary. Uh, Okay, that's a decent chart. The amount of currency units is extraordinary. There's $21.328 trillion of US dollar currency units in circulation. Uh, that, no matter how much they drain, that's extraordinary. And folks are thinking that they're thinking the wrong things, and that's the most important thing that I'd like to cure, as long as well as malinvestment that needs to be cured horribly. So I'm not too. It's not that I'm neither concerned nor not concerned about the debt ceiling. That is a consideration for the Fed as a corporation, how they manage their balance sheet. They have debt servicing obligations, they have income from tax receipts, and they got to make sure their balance sheet works. The implications of the debt ceiling are as I describe in the drawdown of the TGA. And at some point, once they uh, raise the debt ceiling, they're going to recapitalize the TGA account, which is going to decrease liquidity in the system. And in that regard, you're going to see this probably come down, but that depends also what the Fed does, what they do with their QT program, and rates really have the effect on the dollar, and what Japan's doing with their QE is juicing systemic liquidity, and what Japan ultimately does with their rates as well. If they raise rates a tenth of a percent, a quarter of a percent, that's going to significantly draw capital into Japan, which is going to drive up their currency, which is going to drive down the dollar. As the dollar goes down in value, that increases systemic global liquidity, ex-US currency units, everything other than US dollars. So two components of liquidity are important to understand. Global currency other than the dollar, and obviously US centric dollar liquidity. For U.S.-centric dollar liquidity, you look to the Hayes indicator, uh, balance sheet, Fed balance sheet, minus TGA, minus the reverse repo. For global systemic currency liquidity, you look to the dollar. When the dollar is weaker, other currencies are stronger, which means they have an easier time servicing their debt obligations, which means they have basically more capital to deploy. And then you look to the bond market. So it's such a complex froth of activity because you have to look at all the respective bond markets around the world, but obviously the U.S. is a good barometer. It's the largest, so you can look to this indicator, which is still going down. With ample liquidity in the system, if you got $100,000 in a bank account and everything's calm, nothing crazy is happening, the system is stable, what are you going to do with the currency units? You're going to deploy it. So this chart shows you your volatility, your risk of liquidity drain. If the bond market is volatile, it's spiking, there's uncertainty, people pull money out of the volatile assets because they have debt servicing costs. We're talking in aggregate. We're not talking about a specific, retail actor. We're talking about just all institutions, all countries. So it's a very different take than looking at the balance sheet of an individual. So this shows you your decreased risk associated with volatility that could potentially affect available liquidity, and this is dropping, which means the available liquidity in circulation is getting itchy. What's it going to do? What's it going to do? The hook. Hey, Noah, I'm locked in Aura using hidden hand. I missed the voting round this time. On the 23rd, I voted this last round. Will I receive bribes from my last vote? No, you will not. It's you have to be locked and you have to vote for the voting rental fee to be allocated to you. Don't worry, it's 1 week. I've done it before. Everyone's done it, and now you understand the process. It's everything we do is a learning lesson. Name one person that's successful that hasn't either made a bad choice or a malinvestment, and you won't find them. Everyone has made mistakes. The most successful people often have made the most mistakes. What's pertinent is understand what you did, why you did it, and you fixed it already. And that's it. You fixed it. Tapsy's in the house. I'm good. I'm liking what I see in the markets. I really like this indicator more and more lately. Anytime there's a dip below the monthly TWAP, time weighted average price, you see significant market activity, because the currency units in circulation get antsy. I mean, look at the time frames. Monthly below the TWAP, April 2020. What happened between April 2020 and September of 2020? Oh, that was mega 2020 DeFi summer. And then things started to cool down towards the end of the year. And what happened in basically February of 21? Oh, there you go. These are your bull markets. This is the deployment of liquidity to risk assets. When the bond market is not screaming, oh, you're possibly going to need that liquidity. You better not deploy it. That's why this chart is crazy. And this is exactly why risk assets sold off so much in March 2020. It's all about bond market volatility. And take a peek at this. Whoa, January 2017. And then everything went sideways. 2018 stagnant, and it was depreciative because there was this volatility push above the TWAP. But then 2019 came around, and what happened in 2019? There goes the risk assets. And then everything started to stabilize towards the end of the year, just as a not going down, and then everything blew up, and down came the volatility. This is an extremely powerful chart. Extremely powerful. Volatility is not necessarily a bad thing. Volatility is the bucking of the bull. And in that regard, volatility is your friend on the upside. But volatility is not necessarily an issue. What matters is directionality, and what matters is liquidity. If you got volatility and the liquidity is flowing into the market, Like what I wanted to point out this morning was stablecoin liquidity. Let's take a look at all, not market cap. Yeah, total market cap. Here. No, let's go all the way out. Where's the yearly? April. I thought I had January 21 on this chart. Your market cap, total stablecoin liquidity has basically quadrupled in the DeFi space over the last 2 years, from January to January, and it's quite extraordinary. You could have volatility, but if the stablecoin liquidity is increasing, the valuations will also increase. The volatility is going to cure malinvestment. It's going to cure the stuff that doesn't have survivability characteristics. So this is what I talk about with regard to entries being the hardest thing. It's like getting on a moving train. And when there's high volatility, the train slows down, gives you an opportunity to jump on. And the train is the direction of liquidity. So all you do to be successful over the next 5, 10 years is to jump on a moving train when there's high volatility. And the train is the increasing liquidity. You got to find a market with increasing liquidity. What emerging market on the planet has the most increasing liquidity? There's no country on the planet that has a 400% increase in liquidity. Oh, it was Ethereum that showed me the January USD total market cap. Yeah. So mainnet had $20 billion worth of liquidity in January of 21. Has $82 billion worth of liquidity in January of 23. That train is heading in the right direction. This is just the volatility. Volatility is something I'm training more and more to ignore and peer through the madness to the fundamental directionality. And the directionality is really set by available liquidity. Hope that helps. Hey Cap, what's your think of Canto, and is it innovation of CSR for devs? Look like piece of shot for devs. I'm not familiar. I'm not up to date with what's going on there. It's not something I could comment on. Caught me live. Yes, 117K in the house, everybody. I appreciate it. Try my best to help folks out. I hope my Twitter stream is useful. It's some good content lately. Really just honing in on the meaningful stuff and not the bullshit narratives that are so prevalent. Like, oh, when the Fed pivots. No, you want the Fed funds rate to go higher because the stupid NASDAQ is at a ridiculous price and these PEs are absolutely unreasonable and they need to be culled. The cash needs to be extracted from these bullshit assets and allocated to investments that are needed for our country and our world to do better. The cash is needed elsewhere. So I'm in favor of higher interest rates. I think that'll do the markets well. And take that for what it's into context of what I just talked about. Capital flows, liquidity, allocation to investments that are, as a result of extensive due diligence. There's a big future ahead for these assets, and it plays into what I talk about, the employment crisis. And it's not the overemployment crisis. There is a crisis of underemployment. There's 100 million people in the United States that don't work. We have a crisis of available forms of employment. We have a crisis of redefining what the hell it means to be productive, not necessarily from a traditional productivity standpoint of goods and services, but a productivity standpoint of what human beings need to actually be psychologically sane. You can't just sit around and do shit. You have to contribute to a collective organization. You have to be productive. So anyway, so that point of that is I think that is good part of the narrative of what we're playing with in the crypto space is this is an emerging market that offers this potential for new forms of employment because of the capacity to transfer capital digitally, and it's not just what TradFi would think from business to business. This is an entire landscape. This is an entire market of new potentialities. And we see hints of what's possible with with the Web3 gaming, and that's just the tip of the iceberg of new innovative ways to be productive. I find that fascinating to think about because we have no idea what the hell is going to emerge because what we have is toolkits. What we have is a network that supports a capital market. And it's just we have the software language to write that. It's very profound what's going to come in the next 5 to 10 years. Um, Happy Friday, one curious. It's a pleasure. Great to see some bets paying off. Yes, indeed. I agree. It's good to see number go up. Yes, claim your Thana airdrop as a key locker. Oh, there's a Thana. Okay, great. I don't think any of the solidly V1 forks are very interesting. They have a monetary policy that I'm not fond of. Um, Obviously, solidly hasn't been doing so well from a price standpoint, but I will highlight this is MO solid at 55. It looks wonderful, actually. Let's go out to the daily and let's pull up solidly. I posted in their Discord a little bit ago. Maybe it'll help people understand if I show you the charts. So solidly uh, is at its price point from a couple of days ago. So, okay. Obviously, we talk about exuberance, and this is exuberance. It's bullshit. It's done nothing for 8 days. Great. So that looks fine. And solidly, it was the Burj Khalifa. This is absolute bullshit. It's up 200%, 228% from like 13 days ago. So this price point is actually doing ridiculously well. The problem is solidly is overpriced. Now you could have the higher price sustained for periods of time, but I'd like it to see it come down. Um, that'll obviously drive liquidity out of the market. The higher price point attracts liquidity, the higher APRs. So what happens in these systems, it's all about equilibrium. And it's all about capital flows. It's all about these liquidity flow cycles. Liquidity flows because of incentives, and liquidity flows in and out. The capital flows out because people are taking profits. Capital flows in because there's opportunity. When the liquidity flows out, it drives up the rates on the LP positions. When solidity goes up, it drives up the rates on LP positions. So there's an equilibrium that gets reached, and obviously Monolith offers an APR based on transaction fee revenue and the rebase component. So that also drives consumption of solid, but only when solid is priced at or less than the price of MO solid. So there's this whole dynamic of capital flows that I find quite fascinating. This is a superior tokenomics to the other V1 forks. The complexity here is getting on the moving train during a period of volatility and seeing the directionality of total liquidity. This brings us back to the start of the stream, total liquidity and volatility. And this is obviously a short data set to see total liquidity. Um, the solidly analytics page could give it's still also a short data set. It's only 3 weeks old. How the hell are you going to get a sense of anything? So, you know, this falls into the category of, a 1-2% type position in my books. And it's not that everyone is subjective in how they assess their position size. And that's my sentiment. I think there's much more entrenched systemic infrastructure that would warrant larger exposure of a portfolio, and we still have uncertain times with overall liquidity. So this is still a bit of a complicated time to deploy capital. If you go over to total stablecoins, all markets, you see it's a positive sum game week over week, but it's a negative sum game on mainnet. Tron receives a tremendous amount of capital inflow because that's basically the East. And I find that quite fascinating. This is the on-ramp for of collateral that's taking on collateralized debt position in the form of Tether in the East. As you can see, it's up 6%. Tether's up, whoa, 22%? That's interesting. That's a tremendous amount of increase in stable coins month over month. That's very interesting. But you could also see it on the L2s. Polygon's up 2.4%. Avalanche is underperforming. Arbitrum and Optimism we'll look at, and Phantom. Optimism is outperforming. When you have an increase in stablecoins like this, you're going to have exuberance in the markets. There's excess liquidity. Phantom, horizontal. So Optimism is probably outperforming Arbitrum a bit this week in general. Not specific assets on the network, but in general. Um, this is indicating to me a large amount of speculation geared towards retail, smaller actors, because those networks target smaller actors and offer service geared towards smaller actors. So this is a good sign. Seeing Polygon, Arbitrum, and Optimism have increased liquidity is a good sign that retail actors, the smaller actors, are coming back and actually engaging in activity. It's interesting that Avalanche is underperforming. Mainnet is the large actors. That's the macro of the crypto space. But 1.1% is not really a trim from where we've been. And it was predominantly Binance BUSD, which is probably doing interesting things with liquidity, maybe migrating in other directions, maybe going over the Tron. They love that shit. Let's keep it going. Crypto Jake's in the house. Pleasure. Buke. Good morning, Cap. Seeing some talks in macro about inflation coming back. Rates higher for longer. What's your take? I wish we would have higher rates. I wish the Fed would keep bumping rates, 0.25%, 0.5%. The 0.75% is probably going to induce just tremendous volatility. So maybe 0.25% because that's the market expectation for the next hike. And then, you know, data-based, and they go back up to 0.5. They need to keep raising rates to cure malinvestment. There's too much bullshit invested in the wrong places. If you look over at the stock market, it's just disgusting the components of the equity markets. This is a fucking ridiculous chart. This thing needs to just come crashing down, and the capital there needs to flow to much more well thought out needed investments. P&Es of 25, 50, 100. It's the most ridiculous damn thing in the world. Some posts that I put on Twitter this morning talked about emerging market flows. The European exchanges are receiving a fair amount of capital inflow, the largest, as Alessio Urbano mentioned, in decades, and that's wonderful to see. Emerging market capital flows cured malinvestment, things that are needed. The capital needs to go there. They have a shit show going on. This is concentration of capital and bullshit. This is literally a visual depiction of the perversion of the financial system. And higher rates would cure this, but I don't think they're going to be able to. Aside from political pressures and pressures of the oligarchs in the U.S., I don't think they're going to cure it, and frankly, that's disappointing. I would love to see them keep raising rates, raise rates, raise rates, even if inflation comes down. And what they need to do at that point is data-based on other countries and their QE, which is basically an injection of liquidity, and their uh, bank rates, and how that affects overall systemic liquidity, which manifests in basically the dollar index. As the dollar index goes down, liquidity goes up. And if liquidity is up, you're going to see that means there's investment potential. There's capital on the sides available to invest. So cure the malinvestment, increase the liquidity in the system so there's capital to invest, keep bond market volatility suppressed, and that means you're going to get investment in well thought out locations. And over time, with the higher rates, shit balance sheets, zombie companies, they die. That's what you want. But that's not a political narrative that they could really say on TV. If NASDAQ falls to 130 on the freaking monthly, come on. Come on. It's never touched the monthly 200 SMA. What kind of bullshit mean regression is this thing? This is a pig. It needs to be slaughtered. It's horrible. What a shame. Hope that helps. Um, Let's keep it going. 117. Appreciate your narrative and thoughts the last couple of months, but can't wait to become irrational again. Yeah, it's always fun. Always fun to capitalize on the irrational, rather. Next time you're going to be rational and you're going to see what other people are doing. You're going to see their irrationality. And what are you going to do? You capitalize on the irrational. Good morning. Glad to see you release great content. Rational as usual. Dirty Sanchez in the house. Mr. Nobody. CSR is basically contract secured revenue. The devs get 20% transaction fee from the chain. Would recommend to look as there are a lot of interesting ideas happening with Canto. Yes, indeed, as time permits. They also have an FPI free public infra, basically feed decks, lending, DFs. It seems micro. What I want is systemic. I want to own the infrastructure. I want to own infrastructure where there's liquidity. I see the increase in liquidity on the L2s. I know the narrative for the L2s. They're fast. They're cheap. That's great for gaming. It's great for microtransactions. It's great for countless applications that would have a significant market fit and total addressable market because that's what you need. But that's not where the big money is. So I want to follow mainnet. The expensive transaction fees. And then that's okay because the expensive transaction fees are what allow Ethereum to scale properly. It's working perfectly as intended. So I'm quite content with the portfolio structure. And, as exuberance returns, as 117K and mentions, sure, you could deploy a small amount of capital, 0.1% of the portfolio, and to something, and you get outsized returns in a highly exuberant market. So I don't think we're there yet. I don't think we have. How can we be at an exuberant market? So right now, we're just coming off the heels of a bear market. We have an increase in liquidity, which is giving the overtone of, all right, things are stabilizing. There's plenty of reason why liquidity can continue its downward trajectory and start draining significantly. But we're looking at it. We're looking at the dollar. This is global systemic liquidity. And that is a heck of a monthly wick to the upside. That is a shooting star if I've ever seen one. The only other time we've seen a shooting star like this is back in 85, and this one is bigger. So, this is the indication that market has bottomed. This would significantly increase systemic liquidity when the dollar goes down, which is why a lot of people over historically and the crypto space more recently have talked about the inverse correlation to the dollar and risk assets. But this is only part of the equation. You need the systemic liquidity to increase, but you also need the volatility, which is the risk to the availability of that systemic liquidity, to decrease. And that's where move comes in. This is the risk to that systemic liquidity. And when this was going up, that's why the dollar was ripping to the upside. There was risk, like, oh, what's going to happen? I need to pay bills. Anyway, so I stick to mainnet mostly. But I look forward to the time when I could dabble a little bit too, just as 117 mentions. Happy Friday. If you were a speculative investor, would you hold and accumulate XRP? No, I have no interest. It doesn't do anything for me. Solidly, price point is falling, but Velodrome price is increasing. Fascinating market. Yeah, that is what is occurring. Look at all the capital inflow into Optimism. Optimism received an outsized gain in liquidity, 8.2%. Well, there's your increase in prices, and Velodrome is the liquidity churner. There's a fair amount of bribes, which basically is a pressure to push liquidity. So it makes sense that Velodrome outperforms in an increasing liquidity environment, a positive sum game. Just because one protocol has a better monetary policy, it doesn't mean the less optimal monetary policy can't do well. So this makes sense, and that's okay. I often say the best tech is not always the greatest investment. Okay, so you could. Everyone says, well, look, ISO 2022, 20022, and XRP. Okay, that's great tech. Is it going to be a great investment? And Cardano is a wonderful tech. Is it a great investment? And there's a laundry list of shit that we could talk about that's arguably great tech. It's not necessarily a great investment. So this reminds me of that kind of story, and and you know and just because it's complicated. Uh, um, you want to follow the liquidity ultimately. So that's the common thread I look for. How do we assess a technology? We want to allocate to good technology that has sustainable monetary policy, cash flow positive balance sheet, disintermediation of cash flow. But where's the ones that outperform? And and it's not necessarily outperform in short periods of time. You really want the ones that are just trending in the right direction, jumping on the moving train when it slows down. So whether you are most interested in a side chain or mainnet, it's okay. If you can only allocate to a side chain, it's probably going to grow over time. It's probably going to receive capital inflows over time. There's a strong narrative there. Does it outperform? Does it underperform? Doesn't matter. All that matters is the directionality over time. Hope that helps. Asun, good morning. Critical Mass. Working, catch the stream tonight. Got a nice scalp on Spell. Spell is great tech. That's a perfect example of great tech that got the short end of a bad narrative fallout. Um, I hope they do well. I have always liked Danny and what they built. Let's leave it at that. Just wanted to say I appreciate your narrative. It has helped me make decisions that protect my capital, but also at the same time remained exposed to the crypto space and didn't miss this recent volatility. The most important thing is to remain, is to survive. This is a market. You want to be in a market and attach to the direction of the market. If a market is growing over 5, 10-year time horizon, you see the volatility, which is the chop along the way, you want to be associated with that market. I'm not fond, and it's very unfortunate when people get out of markets. It's malinvestment. It's just not a robust enough narrative, which is why I do these streams to help people juice their narrative, make their narrative more mature. It's not just price points. There's a lot more to understanding financial markets, and it's a lot more to understand the capital flows and why they do what they do, and the rationality, the rationale that goes into assessing what is a meaningful place to deploy capital. It's not simple, and the thing that I feel most unhappy about is people that abandon engaging with markets. This is all the opportunity we have, guys, and this is the best opportunity out there. Looking at various emerging markets around the world, this is an emerging market, and this is an emerging market that spans the world. This is not a United States market. This is not the Nasdaq. This is not the S&P. This is a global market. If they juice liquidity in Europe, or liquidity gets juiced in Japan, or even if liquidity gets juiced in Australia, a relatively small market, and all of a sudden this is a market that Australians really want to deploy capital to, come on. This is a global market. This is not a U.S. market. Raul, hello. Let's keep it going. I am Glute. Thoughts on Saudi Arabia stating the WEF that they are open to oil payments in currencies other than the dollar. I love Luke Roman's narratives. This is a big deal, and this goes into the federations that I talk about. And I like to understand how the U.S. federation started around the dollar, and that helps me understand these federations that have emerged in the crypto space. Now, that's a big deal, because what started the U.S. dollar federation really the arrangement with Saudi Arabia to price oil in dollars, the petrodollar. So if they start accepting other currencies, other forms of payment, that pretty much invalidates the underpinning of the petrodollar system. Now, the dollar federation wasn't just by that deal. A federation is an organic manifestation, and it's derived from opt-in participants that choose to accumulate the currency that allows the currency issuer to be a producer and an exporter of that currency. So the dollar is afforded the luxury it has because everyone around the world said it was a good fucking idea to borrow in dollars. And that's why the United States could print what it prints. And right now the world is pretty angry at the United States because they're so dependent on the monetary policy and also the fiscal policy. And right now it's not favorable to the rest of the world. They're doing it for U.S. domestic reasons. That pisses everyone off. This is why every time there's a liquidity issue, other countries get pissy. Saudi Arabia, China, Russia. This is all about currency, and this is all about money, which is all about power and control. So I find that very interesting because the better you understand how the US dollar became federated with every country around the world saying, I want to buy dollars, put it in a reserve, and take out debt dollar denominated, that's how you understand these federations that have been emerging in the crypto space. Currency issuers that have federation components, actors that are mandated to purchase it. What an extraordinary organic emergence in crypto markets. I find it absolutely fascinating. Lord of the Pine Cones, small fish here, waiting for the exuberance, just observing and taking in all the knowledge I can. Keep up the good work. Yes, indeed, the exuberance is inevitable to return, and it's complicated because obviously we look at U.S. savings rate and it's completely collapsed, and auto loans are like it's almost 6% delinquency rates. So the consumer is stretched thin. So, what is the next period of exuberance going to be like? Cycles don't repeat, but they rhyme. So, there'll be a period of exuberance. How much liquidity is available for that exuberance? You'll only know when the cycle emerges. But we know it'll come. That's what a bullish market is. It's a period of exuberance, of increasing misallocation and concentration of capital, and the earlier persons to that liquidity flow cycle capitalize on that exuberance. So, that'll be interesting when it comes back. As much as I look forward to capitalizing, folks, the smaller actors like, oh, I'm going to make money with the stock or a crypto, it goes up. You realize what capital gains is you're taking money from other people. To capitalize using capital gains, buy low, sell high, you're taking money from someone who understands the nature of markets less than you, understands these capital flow cycles less than you do. So I don't have a very high opinion of it. Obviously, I'll capitalize, but that's why I do these streams, to try and tell the story, the narrative of what the hell these games are that we play. Well, what does it mean to have a capital gain? It means you're taking money from other people that bought after you. So it's not really a good thing. It's complicated, very complicated. One curious view: thoughts on capital flows for ZK rollups, less trade-offs versus optimistic. Well, the capital flows are up. Look at Optimism, 8.2% bump over the last week. Arbitrum, 2.1. Phantom's even at 1. Polygon's got 3 and change. Look at Tron, 4.8. Ethereum's got a little bit of a negative sum game going on. So there's good capital flows into the non-Ethereum mainnet chains. And that is actually an interesting sign. The smaller actors are probably encouraged to come back, seeing the price appreciation. The smaller actors, the marginal actors, smaller actors are the marginal actors, and the larger actors who would engage on Ethereum mainnet, or a knock-on effect. They're like, oh, numbers are going up, and that draws in the big fish, because the big fish, obviously, they prey on the small fish. So that's the cycle and the sequence of events. The cycle, it's of the food chain, and we were talking about that in a couple of streams recently. And you got to know where you are in the food chain, and this is all frameable in that kind of story. 0x Klaus, I have been away from crypto for a few months. Is Velodrome now a viable investment to consider opposed to Convex? Uh, um, well, Velodrome is considerable, but look at the available liquidity on Optimism. 633 million versus Ethereum mainnet is 82 billion. And ultimately, any of the solidly V1 forks, I think are at a monetary policy disadvantage as compared to solidly V2. And they're playing in very different playgrounds. All AMMs are optimally considerable as an allocation based on fees, because the whole point of such an allocation is the dividends. Now, what kind of dividends are you going to get on an $633 million network as compared to the potential for an $82 billion network? So you can. It's something that doesn't catch my fancy, but I can see why it catches other people's fancies. What happens if Solidly V2 deploys on Optimism? That kind of shakes things up a little bit. I think they're going for Phantom soon. But where my playground, Ethereum mainnet isn't the playground for everyone. I could appreciate that. I understand that. I was never fond of the large emissions of V1, even if the tokenomics were fixed slightly. It just doesn't have what ultimately got into the V2 reimplementation, which really hits home with Andre's original documentation about the scarcity, the low emissions, price appreciation. It was drives APRs instead of dilution. So it's just not something that interests me. Not many things on the side chains interest me. I mean, look, even Cheat came to mainnet because it just doesn't. There isn't enough liquidity on the side chains for there to be significant, like really significant activity. The big stuff's on mainnet. Lake Meadows definitely helps. It's a pleasure. Hilda's in the house. Much a pleasure. Joe, what of sovereigns could bribe bondholders for U.S. foreign direct investment receipts? It's complicated. Sovereigns, they're not going to really change the name of their game at all. They have a very narrow mode of operation, and they're just going to keep doing what they do. Thoughts on Zen? Pretty much completely off my radar. 0x Klaus makes sense. Thank you. You're welcome, guys. I hope that helps. It's a Friday, and what's going to go on into the weekend? Everyone's like, oh, Bitcoin's going to nuke into the weekend because that's what it's done for all year, basically 2022. But look, almost at a higher high. This is just the increase in liquidity in the system. So, rather than looking at a Bitcoin chart, people are looking at the wrong charts. Look at the dollar. What you want to see is here on the monthly. You want to see this. In 4 days' time, you'll have the first close below the monthly TWAP in a long time, since May of 2020. What happened in May of 2020, by the way? May of 2020 is when DeFi Summer went complete hyperdrive. Just fun fact. So May of 2020 was big. That was the start of DeFi Summer. It wasn't, March is when the collapse happened, but May is really when everything went apeshit. So the TWAP on the monthly is a big deal. So what you have is a bit of a trifecta of confluence. You have the breaching to the downside of the monthly DXY, which is indicative of increased global liquidity other than dollars. And then you go over here and you have decreasing bond market volatility. So when you have the confluence between decreasing bond market volatility, which is the risk to systemic liquidity, because you can see the bull markets on here too. So you have the decreasing bond market volatility and the increase of systemic liquidity. That's two factors of bullish confluence with regard to increasing effectiveness of systemic liquidity to drive capital into risk assets. Um, this is indicative of bottom. That is pretty comfortable to say that, along with the third piece of information, which is the highly controlled U.S.-centric liquidity equation, which is the Fed balance sheet. So the this is stabilized. So this isn't increasing. So the third component of what would be a trifecta of bullish confluence with regard to systemic liquidity isn't there, but it's stable. So this isn't a detractor to the stability and increase of overall systemic liquidity. If this starts dropping, if they raise the debt ceiling and the TGA starts filling up the account, this will be a headwind on systemic liquidity. But maybe if the 0.25, we'll see what rates do, because rates dropping, if other countries are tightening, if Japan tightens a little bit, we could really see the bottom fall out on the dollar. That would be an interesting manifestation. So, and this is really what I see between this chart. This is a position of weakness for U.S. domestic liquidity. And this is a position of strength for global systemic liquidity. And this is exactly why we see emerging markets getting capital flows. There's more liquidity outside the dollar right now. There's pressure on the dollar to come down. Very interesting. So this is the strongest indicator of global liquidity, is this simple chart. And obviously you could look micro currency, one currency versus another, but this is basically the euro and the yen versus the dollar. If you just look at this alone with a microscope, anytime there's a breach below the monthly TWAP, there's always follow-up months. Look at this, back in 2020. 1, 2, 3, 4, 5, 6. It's like a year worth of follow-up months. Look at the breach. It was exuberant and it went way above the monthly TWAP. But once it breached the TWAP, it was over for up until the summer of 2018, all the way from June of 2017. So there's your bull run, and a lot of chop between 03 and the 14. This is a bit of a different story, but these are your two most recent exuberant cycles in risk assets. But it's the same story. Nothing changes, just the structure and the potential correlation you could see between bond market volatility and U.S. domestic balance sheet liquidity. What's interesting is this chart. This is brand new since 2008. This never existed. So this changes the equation. So you have to take that into account when you're looking at the currency indexes. Below the TWAP on the dollar, below the TWAP on the move, and if you start to see this go up, that's just the trifecta of liquidity confluence. Hope that helps. We didn't look at CRV. Let's take a look at Curve. Hilda, any Metis? I've heard interesting things about Metis. But it's the same narrative. It's how much liquidity is flowing over there, over the bridges. So it's the same narrative. With regard to L1s, you guys remember I talked about Cosmos because that's integrated into the BSN. So that has a very large China narrative, and Polkadot as well. So of all the alt L1s, those are probably the two that I still favor, and those are the ones that I have from late 2019, early 2020. Let's take a look at Curves, because you asked, Maximus. Curve is in a very interesting spot. Curve recovered significantly from the short attack. Curve is above the 200 SMA on the daily, above the TWAP, and has been holding there for quite some time. So it's got a nice flag going on, more or less, coming off the rip through moving average resistance. So what you want to see is the holding of the 200 SMA, flip resistance into support, and the higher high, 120s, That'll be the trifecta of bullish confluence. The only thing better than that would be, instead of it hitting the 200 SMA, is the daily TWAP holding as support. What do we see down here is the 50 SMA on an upward trajectory, and that would be a golden cross if it makes its way to the 200 SMA on the daily. Let's go out to the weekly. So we finally have, this is the first time in a long time that we have an upward trajectory on the TWAP, on the weekly TWAP. That is very good to see. Obviously, we have 50 SMA resistance above and the 100 above, but it's not enough data really on the weekly to get too much of a sense of the big picture. It's very interesting to compare these two periods of time, May 22 to current, and the last time we were down in this price region. Double bottom, but it was a different story back here in 2020 compared to now. Now there's an entire federation that's sucking circulating supply. This was just hyperinflationary decay. Very different story for this price region. Very interesting. We're above critical price points. If you go out to the daily, you can see the historic price points. Yeah. So that's big. You're above. So back in 2020, curve ripped to 97 cents in a complete exuberance. This was exuberance back then. And it was like, whoa, what the heck is it doing at that price? No one is ever going to keep buying it. And now people are buying it at that price as support, as potential support. Extraordinary, the narrative difference between then and now. This is a historic resistance flipping support above a moving average, above the time-weighted moving average. Wow, very interesting. Let's go out to the monthly. So this is probably my preferred chart to look at. It has the least data, but I think it tells an interesting story. So this is where we are. We're sitting below the 10 SMA on the monthly, still below the TWAP. Plenty of time to get back to the TWAP, $1.85, probably summer, something like that, unless we see liquidity issues in the overall system. Take a look at the RSI. This is probably the most interesting thing. And it's going to take time. Monthly charts take forever to play out. This is curve. This is the entire history of curve in a little line of just a very little line. But look at the RSI signal cross trajectory. The entire history of curve is decreasing RSI. And we finally have a higher high and an intersection with the monthly TWAP, with the monthly RSI signal. This is very interesting. No rush. Take your time. I like the way this chart looks. This is the currency issue of the crypto space because it's a federation that's accumulating the assets out of circulation. Very interesting. Is solidly a threat to curve? No, it is not. Is solidly very interesting as compared to curve? Sure. Is solidly a threat to Uniswap? More so than curve. Solidly is certainly a threat to Uniswap more so than curve. But Uniswap has tremendous dominance. It's all about momentum. First to market. They already proven lendiness, so they're trustworthy. That's a big deal. No, their solidly is not even remotely immediate threat to any of them. But if it grows into a threat, it'll be a threat to Uniswap way before Curve. Curve, everyone has a vested interest in Curve. You can't abandon vested interest. This is the federation, the countries, the protocols that have accumulated Curve and Reserve are dependent on the existence, survival, and well-being of Curve. That's the story of the federation. Last couple of questions. Did you see Makarov tweet thread on recession indicators? He seems convinced the market is wrong. Well, recession is irrelevant. It's irrelevant relative to what we do. Recession is a big deal with regard to the average working citizen, and that gets into all these political conversations about labor and salary, and that's not something I want to digress into towards the end of the stream, and it's a whole different tone. And it's horrible. It's horrible. And the extent of what I could do to help people is literally just financial education. And you can't get anywhere saving. You can only get ways somewhere investing. And that's a whole another conversation. So I'm not too afraid of recession. I think recession is healthy. Clearly, that's increasing job losses, and then people are fucked, and they don't have money, and they can't pay their bills, and it's an absolute humanitarian catastrophe, and that's horrible. But a recession doesn't mean shit with regard to the amount of currency units in circulation, which is the largest quantity of currency units in circulation ever. It's a tremendous amount of currency units. It's barely come down, USM2. I want white charts. I want Fred. The amount of currency units in circulation. They're going to have a recession? This is the sum of the game. This is the currency units you're chasing in the macro market. And then you look over to DeFi Llama and you see the micro market. So how many currency units can flow into the micro market? However many they are in the macro market. And what have we seen in the micro market? A 400% increase in currency units over a 2-year time frame. So I don't really hesitate too much about recession. Um, it's just everything's about liquidity. Drunken Miller talks about it. It's all about liquidity, liquidity and volatility and directionality. That's it. That's the common thread. Um, oh, one curious. You said the bond market is wrong. Uh, well, the bond market may be wrong or right regarding recession is irrelevant to me and what I focus on. And to me, what matters is the volatility. In this regard, this is interesting. The bond market volatility is down, very down. And anytime the bond market volatility is below the TWAP on the monthly, from this trajectory, there's a significant increase in risk asset deployment. Significant. April of 2020. Oh my God. Breach of the TWAP to the downside in April of 2020. What happened to risk assets? Vertical. Okay. The currency units in circulation is extraordinary. Um, I love your delivery, Noah. It brings me back to 21 when you were talking about Spell and the unknown little project. Good times. Yeah, it was a big deal. It was big tech, and that was currency creation, collateralized debt position. Nothing changed. In fact, their tokenomics are just better. The problem is, what is it as a systemic component, as a DeFi Lego? Um, it's exuberance. It's a tool that's used during periods of exuberance when there's low volatility. It's a Eurodollar, literally by definition. So it's a very meaningful tool, but it fits into the entire equation um, in a way that requires consideration. As you could tell, it's very interesting. It's a very different story I tell now as compared to back then. Yeah, that was good times, maximum. Robert, any thoughts on crypto regulation? Yeah, not really. Yeah, my thoughts on regulation are go regulate the stablecoins, great. Gets more stablecoins, there's more liquidity into the space, and all that matters is you can interact with contracts directly on Ethereum if you have a node, and you go right to the contracts, and that's all that matters. So because it's not regulation by what country? By the United States? What does that have to do with Canada? What does it have to do with Great Britain? What does it have to do with every other country around the planet? Regulation by what country? Is crypto a U.S. market? No. Crypto is not a U.S. market. It's a global market. So what does the regulation of the crypto space have to do with the United States? So regulation, that whole conversation drives me nuts. Shish. Hey, Noah, I was talking in Discord about Solidly yesterday. Was I correct in the dilution of revenue from their locking program? Yes, I believe. Um, you know, fair amount. Roosh moved his Elmo out to a VE position, and that was a significant uh, undilution of persons that have Elmo. So that's a big deal. So that dilution's a big deal. And right now it's undiluted. So there's more revenue. Notice it went from 24 to 27%. So that's cool. I, you know, don't get exuberant with anything in the market right now, but definitely keep an eye on the market because something's close with the breach of bond market volatility to the downside and the breach of dollar strength to the downside of the monthly TWAPs. Something's interesting. We're close. Either it's a head fake and everything reverses and the dollar spikes up, or there's some sort of liquidity crisis and bond market volatility goes through the roof. But this directionality is heading towards the soft landing that everyone's talking about. Um, like I said, I'm struggling to understand those mechanics. Yeah, solidly is, it's new, it's shiny, it's a couple weeks old. Went through a period of price action exuberance, and solid is overpriced. Um, you need more data, you need more time. Um, maybe folks got in with Mo Solid at 40 cents, the low end of the spectrum, or Solid was at $1 and it's at $3. So, there you go. There was your train that slowed down. And then you jump on, and that's position size, and then you just let it go. And the directionality is upward. The liquidity flowed in over the last 3 weeks, and it's flowing out because price action is down. But that's a liquidity cycle. It's the same thing we talk about global macro liquidity and U.S.-centric liquidity and non-U.S. currency liquidity by looking at the dollar index. It's all about liquidity and cycles. In your opinion, is a soft landing realistic? That's what I just said. If the directionality of the market right now is a breach of the dollar to the downside of the DXY and the bond market volatility decreasing, yes, this is soft landing territory. This is very interesting. Or at least this is risk asset capital deployment. Increasing rates could cause some significant volatility with regard to corporate balance sheets, and they need to lay off to balance their books. So, I don't know. Recession is a funny narrative that is totally mistaken and hard to digest. There's a lot of moving parts. And it'll be very unfortunate if we see a relatively strong recession, increase rates for a period of time, which I would like to see to cure malinvestment, but the increased rates could easily cause corporations to have to balance their balance sheet, which just causes unemployment. And then to top it all off, the U.S. dollar is going through a currency cycle, and the bond market volatility crashes, so risk assets completely take off. So we have a recession, and risk is blowing through the roof. So that would be a very difficult political situation. So there's a lot of complexities going on. I hope it helps, guys. Friday, January 27th at 12:34 p.m. As always, thank you all for joining. Tell everyone to subscribe. If you don't listen, I can't help. It's a good week. Enjoy the weekend. We'll be back at it Monday. After party on Discord for the most rational community in the entire crypto space. I appreciate everyone in there. I will see you on Monday. Peace.